So happy to welcome to Monetary Matters Steve Ho, Senior Researcher in Equity and Multi-Asset Indices at Bloomberg. Steve, great to see you. Welcome to Monetary Matters.
You as well, Jack. Nice to finally meet you on the podcast.
So, Steve, I want to talk about your work that you've done on the government bond market and how the U.S. Treasury funds itself by issuing debt, and how where it issues on the curve impacts term premium. Because this is an issue that when you originally wrote your PhD thesis years ago wasn't receiving that much attention, but this topic has really blown up as the U.S. debt has continued to balloon skyrocket, mainly in 2020. So I was just reading it. Walk us through a few of your claims about the U.S. Debt. I guess let's start. How does the U.S. Treasury think about where it wants to issue on the curve, whether it wants to issue a 1 month or a 3 month Treasury bill, or a 10-year Treasury note, a 20-year or a 30-year Treasury bond? How does it go about making that decision? I think that's something that's poorly understood by me and probably a lot of people in the audience.
This was my PhD work at the University of Michigan. And as you said, it's back in 2017, and there was the motivation at the time was the Fed was going to unwind its balance sheet, and there was worry about what this might do to asset markets, and that motivated to understanding sort of effectively this will be unloading a bunch of treasury securities and how that might affect, treasury yields and asset prices. So at the time, it was actually, I was struggling to get people's attention on this topic because at the time, inflation was not, anywhere on the horizon, and government debt, whilst large, people were worried about other, sort of top of mind issues, including the fight Trump was having with Powell. And in any event, the Fed did not proceed with its, sort of unwinding. So that whole issue kind of went away a little bit. But my work at the time basically focused on two aspects. In one aspect, the main chapter of my dissertation, the first chapter, I was asking when is the supply effect large in the government bond market, right? So, and just very quickly, the intuition there is basically the finding there is basically to the extent that one thinks about the Fed's summer portfolio being unwound and outright sold, you're talking about a bunch of debt being unloaded onto the private market, and then it has to be absorbed by investors. And to the extent that you think about investors' consideration about these bonds, they are thinking about not just the risk, they're thinking about correlations, right? How would the bond affect the overall riskiness of my portfolio, which depends on how bonds co-vary with other assets, right? So when you think about it like intuitively, the findings should come as no surprise to anyone that the price for absorbing supply, right, from the private market's perspective, depends a lot on the extent to which bonds co-vary with stocks or other real assets for which stocks is a proxy. And stocks and bonds, if they are positively co-varying, then bonds marginally will add riskiness to the overall asset along the beta portfolio, and you would expect investors, the arbitrageurs, demand a higher fee for inventorizing the bond supply issuances. And to the extent that stock and bonds were negatively correlated, between 2000 until just before the pandemic, you had this 20-year period during which bonds were sort of essentially negatively correlated with stock returns and very attractive as a sought after safe asset, right? And this was essentially spelling out a career of Bill Gross and Ray Dalio, sort of the triumph of risk parity and bonds just 10-year going in one direction. So in this environment, you would expect supply to have a more muted effect on bond yields. So that's basically the main finding of my first chapter. And then I'll pause there to let you ask some questions before I sort of talk about the second chapter, where I sort of study the realistic rules with which the Treasury has actually issued debt, which you also alluded to.
So the Treasury aims to issue debt and funded the government at the lowest cost to the taxpayer. And for a long time,
Yeah.
it's kind of intuitive, thought that okay, if an upward sloping yield curve, like overnight money is at 3% and the 10 years at 5%, the Treasury would fund itself, in overnight and in shorter term bills. If we have an inverted yield curve, which is rare but happens, such as we had in last year, let's say, the Treasury would want to fund itself longer term. But actually, the academic work and what I've learned is actually true is the Treasury assumes that the yield curve is kind of correct. So when you have an upward sloping yield curve, issuing at 5% and the long end doesn't save money because ultimately what the curve is telling you is that short-term interest rates are headed to 5%. So really what the Treasury cares about is the supply effect. Basically, how much is it going to move yields up if it issues in that tenor, I guess. So if it issues 10-year Treasury notes, how much, it increases the supply and holding demand constant, the price should go down and yield should go up, but how much? And that's called the supply effect. Your work found actually that the how much the yields go up based on supply, in other words, the elasticity, I guess, of that depends on stock bond correlation. And if stocks and bonds are negatively correlated, meaning that when stocks crash, bonds rally, bonds are a really good hedge for a portfolio. And actually, the supply effect can be negative, meaning that the more the Treasury issues, the higher the price is and the lower the yield is. And that's counterintuitive, but that is really interesting. So in a world like in 2020, where bonds, in March 2020, long-term Treasury bonds, there was a time where they actually sold off, and that was very scary. But ultimately, the 10-year, I believe, did get to below 1%. I think the intraday reading of 10-year was extremely, extremely low. They ultimately proved to be a good hedge, and so yields would go down. The supply effect, your work would say that was negative. But in a time where stocks and bonds sold off together or rose together, so and that's what happened in 2022, which is quite scary for the 60-40 diversified long only beta portfolio, let alone quantitative strategies that are heavily leveraged and rely on exploiting these correlations, such as risk parity, which of course includes commodities and other assets as well. That the supply effect can be very, very positive, meaning that the more you issue in the 10-year, the 30-year, the more those yields rise.
Yeah. So, I mean, as with anything, sort of, you are talking about an equilibrium outcome, right? There is the demand side and there's a supply side. I mean, the two chapters of my dissertation actually sort of dealt with, the two angles a little bit, right? The first chapter sort of studies, a way in which, variations in demand sensitivity will affect, right, how the result in the shift in the supply curve, right? That's the first chapter. In the second chapter, I document a bunch of stylized facts of what has historically summarized the way in which Treasury has approached debt issuance, which is a very little studied and understood subject. Because for the longest time, it's boring, right? Nobody really thought about this subject. It's a tiny little office manned by a few people in the Treasury Department and the debt management office. And you're talking about trillions and trillions of marketable securities out there. The Treasury has very limited capacity to be tactical in a meaningful way. It's not a sort of hedge fund. It doesn't really have the ability to respond that quickly to movement in prices. And in any event, it is not really that sort of I think opportunistic when it comes to sort of short-term price fluctuations. So what I found was that sort of the four stylized facts is that more than about half of the decision for them is just adjusting how much to issue, in terms of with bills, right? There's the extreme short-term money instruments between up to 1 year of maturity, and then the rest of it. And then the second fact is essentially that they have a sort of strong desire to spread the issuance, of long-term debt that's above 1 year across the tenors, right, to maintain liquidity, for different tenor points. And all of this is always constantly, communicated with the private markets, which are represented on the board TBAC, or the Treasury Borrowing Advisory Committee. And then there are two more factors that sort of the weighted average maturity of issuance, which is their margin of decision, right? Tends to lengthen in response to sort of rising funding needs, right? Which comes as in two sources. One is technical. One is more structural. The technical one is if they have a whole bunch of long-term debt maturing, so that tends to have a temporary, impact on issuance, maturity tends to sort of push that out a little bit, but then it comes back down. It's sort of a ripple. But second one is more structural, where you have a big shock, right, to the federal deficits, especially after a major recession where the government tends to run up deficits to stimulate the economy and perform countercyclical, macroeconomic stabilization. And then the fourth one is actually sort of a little bit intriguing, is that there's yes, it turns out because of the first three factors, especially the last one, there is actually historically a positive correlation between issuance maturity and the term spread, where the government, you would think they would want to issue more long-term debt, right, when the long-term yield is relatively low, but they have actually historically regularly issued exactly when the term spread or the term premium is highest. Now, so make that what you will, but I think recently we had a little bit of political controversy, that was brought up about how the Treasury has operated, since Q3 of last year, and as far as my research is concerned, which was actually quoted by Steve Moran and Dr. Ravini in their paper, it's actually quite consistent with how historically they have conducted, operations.
Okay. So when there's a recession, or let's
Yeah.
call it a macroeconomic shock, debt to
Mhm.
GDP mechanically increases
Mhm.
because of automatic stabilizers. People who get laid off, they go on unemployment, automatically the deficit increases.
Mhm.
Uh, they're countercyclical tax cuts, automatically the deficit increases. That is typically in a Keynesian thing viewed as a good thing to combat recessions. And so the Treasury, when there's a recession, issues on the short end. Why? Because short-term Treasury bills are kind of like money, so it's just not taxing the financial system that much, as opposed to funding at the 10, 20, 30-year lend, which requires a lot more balance sheet.
So generally is really more just market demand. They cater to demand, right? So out of usually in the middle, upon impact of a recession, there's a lot of demand for liquidity in the economy, right? And the Treasury tends to issue a lot of bills, upon impact, to cater to that demand, and also sort of harvest some of that liquidity premium. But I think that's not the primary motivation. It's just, I think there's just a lot of demand, and they meet it. So the Treasury, like I wrote in my second chapter, this little simple model where the Treasury is always balancing more or less two factors, right? Sort of the opportunity to earn some liquidity premium, but then at the risk of rollover risks, right? So how much are you going to sort of keep in your extreme short maturity that's just rolling over all the time? If you think about all the economic agencies in the U.S. economy, of everybody that is out there borrowing, the U.S. government probably has the highest capacity for bearing rollover risks. It's not some little company that has to go out there and borrow, right? It has that nominal credibility. So what has to, through a business cycle, what typically happens is that upon impact of a recession, economic shock, Treasury issues a lot of bills, and then as we exit from the recession, at which point the yield curve tends to uninvert itself, right? Normalize.
Stephen, yeah.
That's why the yield curve steepens. And then, that's also when deficit to GDP or debt to GDP has run up a lot, right? During this period, the Treasury tends to lengthen the maturity of its debt portfolio to bring it towards its, sort of target historical weighted average maturity of the entire debt portfolio, which is why you see this interesting pattern. And indeed, you saw this again, by the way, after the COVID, recession, where the weighted average maturity plunged momentarily, right? And then you bounce right back, and in fact, peaking at is, I think, sort of 40-year high, at the end of the third quarter last year. If you think about the Treasury as just like, if I put you, Jack, in that position of say, so hey, we have a huge amount of borrowing, manage this carefully. We want to sort of, borrow cheaply, but also don't screw up, right? Don't go crazy. You would do something along this line where you sort of maintain roughly a reasonably long average maturity, so that not all of your debt obligations are maturing all at once, right? So they're, I think, a little bit, sort of spread out. Um, and you try to do it, in a moment that is not causing too much market stress, because demand curves are downward sloping, right? So and there is also a market demand for liquidity across the different tenors, especially at the key sort of maturity tenors that markets likes to trade. 10 years is a key tenor point, of course, 257. So that being the case, what you end up doing is more or less where you sort of tactically, in the moment of shock, may issue a ton of bills that will raise your rollover risk, as at least momentarily, and then as the crisis passes, right, you will basically start migrating more towards the long end, right? So as the short-term bill matures, you will try to issue more and more, long-term debt, going out the curve. And what is typically fortuitously the case is that upon impact of a bad recession, especially, the entire curve level, right, tends to be lower, so that the slope doesn't really matter. It's kind of second order. So the whole level shifts down, and then initially you move to the short end, and then the curve steepens, but still generally at a relatively low level. You can move further out the curve, so your entire that portfolio is actually spread out, sprinkled out, along the entire maturity curve, but still at a generally affordable level. That's what happened after COVID. Exactly what happened, right? The recent controversy is only that sort of, the entire curve also had a re-rating because of the whole sort of regime shift with inflation, that we're now facing a very high curve, right? I think that's part of the problem that we're facing now, right?
Thank you, Steve. So we'll get into the controversy about activist Treasury issuance, whether the Biden-Yellen Treasury is manipulating the Treasury market. Not my words. And that the U.S. debt was downgraded from AAA to AA, I believe. But just to put a point on it, so rollover risk is you borrow money in short term, you have to pay it back, and you struggle to refinance that debt. So in the private market, that happens very frequently. For real estate developers, for example, they borrow short term, they have to pay the money back, and interest rates shot up. They may have a hard time with that. But the U.S. and other governments around the world may have a hard time with that. But Steve, does the U.S. government effectively face rollover risk? Like, I feel like going back to a time where the U.S. government, like, can the U.S. government borrow money? I mean, you'd have to go back to like the Civil War. I feel like, the U.S.
Exactly, which
has
is
been the best credit for well over 100 years. Am I wrong?
Yeah, exactly. Which is why I actually, in my paper, which I will actually put up finally, the second chapter, I put rollover risk, like I put quotes around rollover. I mean, the US government fundamentally as an entity doesn't really have a very meaningful amount of rollover risk. It's just, I think, psychologically and maybe institutionally unpleasant to be saying, we're going to be issuing 20 trillion or 30 trillions of T-bills, like all at once, every few months. Right, I'm making up some numbers here, but that you sort of get the point, right? It's more just institutional prudence. I would say more than anything, there is a market demand for the Treasury to be issuing debt further out the curve, more than the Treasury itself really needs to be sort of doing so much issuance, in all these random tenors. In fact, I've always been pretty critical of the decision of issuing TIPS. It's quite expensive, and it seems to me like the entire motivation seems to have been, motivated by a desire to observe market implied inflation expectations, which seems like a very expensive way to do it. Yeah. by issuing real commitments. But in any event, yeah, I mean, to your point, I think the rollover risk is kind of a, in quotes, soft one. Generally, is the idea is those four facts I pointed out, right? And in fact, you find that to that exact point, is why Treasury has actually felt quite comfortable historically having a fairly large amount of its debt portfolio at very short maturities because the liquidity and relative safety of its confidence in being able to renew its debt. Yeah.
So if we put rollover risk aside as kind of not the real reason, what are the reasons that the U.S. Treasury wants to borrow long term, if not for rollover risk? You said that the market can want it, but if that is the really only reason, isn't that kind of not a good reason? Because just because hedge fund managers or the private markets want something doesn't mean the government has to give it to them, right?
Of course, this whole thing comes with historical evolution, and the market has matured, and but this came as a long journey, right? After World War II, when we transitioned away from this one-off war bond auctions and so on, and became much more of this regular, predictable, market where debt is, constantly issued and rolled over into the similar tenor. There's just, I think, a certain institutional momentum of maintaining that, and generally it's not a bad idea to have a good chunk of your debt that is not sort of maturing so much all the time. Then from an operational point of view, you avoid accidents, right?
So let's. What do you make of the accusation against the Yellen Treasury administration that she was involved in quote unquote ATI, activist Treasury issuance, i.e., issuing a lot of Treasury bills in order to stimulate markets? And I guess Steve, the accusations of ATI have two components to them, really, as I perceive them. Number one is that issuing Treasury bills is stimulative to markets and the economy. Issue two is that it was the intention of the Treasury to do that. I think issue one, I mean, definitely could be true. I mean, it's kind of a fact of monetary plumbing that a 1 month Treasury bill is a lot more stimulative. It's basically money, whereas a 30-year Treasury bond is an investment. It's a security. I mean, 1 month Treasury bill is a security too. But I think that's just a matter of fact. But like I think that the Treasury was fulfilling their own job of tax cost to the taxpayer. The markets wanted short-term Treasury bills. Demand was high, rather than manipulating the markets. I think intention is very hard to prove. So what do you make of that claim? And just your general thoughts on it?
So, first of all, Steve Moran is a good friend. I like him very much, and
I
I
like it
respect
too.
I respect his work very much. And I sort of he actually cited my work, referred to it in his white paper. From a quantitative, perspective, to the extent he was estimating the impact of these debt maturity structure changes, and whatever short term impact it might have had on bond yields, I don't really particularly disagree that much. What I do find a little bit curious is this whole sort of controversy, quote unquote, because I don't really see this as like deviating that much from how Treasury has historically conducted itself. And in any event, I don't really think it's that big of a deal. So let me tell you why. So first of all, we already mentioned, right? Historically, the Treasury's issuance decision around the curve has always been that they tend to go very short maturity upon impact of a big recession. And COVID was as big as it comes, as it comes, and weighted average maturity did plunge. If you go to the TBAC presentation the Treasury's presentation to the TBAC committee, which they put out every quarter, you will see this chart that plots the weighted average maturity of the marketable debt outstanding, and it did plunge right in 2020, reflecting the issuance of T-bills, and then it bounced right back. And in fact, it continued rising from the bottom of COVID all the way through the Q3 of 2023. And I think by Treasury's own calculation, the overall debt portfolio had a weighted average maturity about 70 months, which is substantially higher than its historical average since 1980, based on the chart, right? So in
Yeah, I
fact,
mean, I think it's higher than any level since the
correct.
1970s or maybe even the 1960s. So
Correct,
yeah,
correct. So this argument that the Treasury did not term out the debt is just very bizarre to me, because it did, right? It very much did, and the Treasury kind of, as a debt borrowing, agent, acts kind of, opportunistically in that regard, right? So in fact, the idea that they will counteract the Fed is not the first time either. Like during QE, the Treasury will try to issue long-term debt. So hey, wait, there's a new buyer in the market. We're going to issue a ton of new long-term debt, right? So I think they did exactly what you would expect them to do. Of course, if you're the Treasury, you can't really just go out there and borrow $500 trillion and let it sit on the balance sheet, just in case interest rates go up in the future. You can only have the ability to borrow up to the debt limit, right, and up to the spending needs. So after that first wave went away, when you had substantial, and we continue to have more borrowing needs, especially due to interest rate cost itself and debt service cost itself, which has become a substantially part of the overall federal deficit, then you really have no choice. At which point, if you are sort of ignoring politics entirely, which I don't think is a factor here at all, personally, I think they just perceive themselves as having some wiggle room here to not have to lock in long-term borrowing at historically high 10-year yield, and believe, as the market broadly believed back in 2023, that long-term interest rates will come down gradually, and they will be able to borrow and term out, whatever additional borrowing at hopefully lower interest rates. As it turns out, 10-year yield did come down a lot, and then you shot up again. But I think this whole, but the thing is, if you look at 10-year yield where it sits today relative to say the peak of Q3, you are still not higher than what it was back then. In other words, you have had this entire time, right, to still do what you need to do to term out the debt, right, if that's the consideration here, and not rather than sort of pushing a whole bunch of long-term debt just as the market itself is panicking a little bit about, the whole supply and whatever issue back in Q3 2023. So, that's kind of how I see this whole issue. I think the significance has been. I think the whole motivation, I don't know where it comes from. Like I don't see evidence of it, and I think also, even I think the economic significance has also been overstated. We will see how the new Treasury under Scott Bessent and in fact, our good friend Steve Moran, who's becoming the incoming chair of CEA, will handle this situation. But I suspect a certain continuation of historical conduct will resume.
Right. So in March 2020, under the Trump Mnuchin Treasury, and where Steve Moran worked, the Treasury issued a lot of Treasury bills, which is in accordance with mainstream policy of when you have a financial crisis, an economic crisis, a recession, a depression, you issue a lot of short-term Treasury bills because that's what the market wants, and it also kind of provides a much-needed stimulus. So then Treasury was so the bill share there was very, very high, and it spiked bill share as a percentage of marketable debt outstanding, as bill share also as a percentage of net issuance. And so there, the Stan Druckenmiller critique is accurate, I think, of, well, when interest rates were so low in April 2020, March 2020, they should have issued a bunch of long-term debt. But I think that's a conflict of a private markets hedge fund manager's view versus a Treasury view. Like if the Treasury wanted to make money, yes, it should have issued a ton of short-term, I think the 10-year bottomed at 50 basis points. That would have been very good for the public purses of the United States, but it probably would have caused a disruption in markets, and it could have exacerbated that recession and inhibited the recovery. Your point is that later on in 2021, which just so happened, again, I think it's a pure coincidence, but Yellen and the Biden Treasury extended the debt, and so did the opposite of what the ATI accusation is. And they that was because you're emerging from a recession, and the market now wants longer duration coupons, and you want to move the weighted average maturity, the WAM, to more historical levels. So that's I just think that the weighted average maturity right now is very, very high. It is slightly lower than it was during the early years of the Biden administration, but during the early years of the Biden administration, it was the highest it's been since the late 1960s.
So I think from a, so to speak, stock, right, in terms of the decisions that have already been made perspective, I don't think there is really too much to be said about what they have done. To a certain extent, you can't really pre-commit all of your future selves good decisions today, right? You can't be like, oh, I'm going to commit to a healthy diet by not eating today forever, and just so that, because at some point you still have to revert to eating something every day. So um, I think that's part of the tension, and I mean this idea that the Treasury, sitting on top of 20-30 trillion dollars of debt portfolio can act very opportunistically, very quickly is not realistic, right? And and they are not always going to be acting on the dot, right? But over time, I think it averages out okay. I mean, just like when people were freaking out about Biden, releasing the oil strategic reserve to help with oil prices, right? And people are like, oh my God, he's releasing all this oil and he's not refilling it, and price is slow. But then you look at the price, it's like, when it came down a lot, Biden didn't do very much, or did a little bit, and then price went up, and then it came down again. So now, okay, fill it, and they are filling it. So I think that's kind of how the government has typically operated. They operate, not that quickly. But I think if you get the main forces right, on average, you're going to be okay. But I mean, right, obviously, right now, uh, I think the debt interest rate expense and debt service cost is going to be very much for first order, and whoever has to tackle and deal with it is going to have a big problem, that a tough problem they have to solve. And I don't think locking in whatever debt we had incurred a few years ago at historically low rates really would have helped, in terms of the new debt that's being incurred, in terms of debt service, interest expense, and new spending, and so on.
Yes, when we talk about the Treasury has zero power whatsoever to
Um,
influence the deficit, how much the government has to borrow. Its only job is to fund the government and refinance the old debt as well as borrow new money for the new deficit. Steve, so if the Trump Besant Treasury tries to extend duration and borrow more long term, do you think that will have a supply effect where 10-year yields, 30-year yields will go up because of the supply of bonds? And how much of that depends on your view of the stock bond correlation, which I believe is now negative once again, I believe.
yeah. So depending on how you estimate the stock bond correlation, which I had earlier suggested, essentially is proxies for the price of duration risk, right, or how much one charges for absorbing treasury supply. It has been falling pretty rapidly over the last few months. Uh, so that's good, right? So in terms of market price for supply is lower than it was before. Uh, I don't know what the new administration is going to do in terms of that management, but I suspect it's going to become of high importance than it was in the previous 20 years, prior to COVID, right? Uh, um, I expect them to move, judiciously and generally extending maturity, just because that's kind of how historically the Treasury has always done. Is that we said, sort of the four facts that I laid out in my dissertation. The third one is that if there is rising deficit, right, they are going to want to respond by extending maturity. Even though the entire curve has moved higher, you don't really have that much of a choice. But I suspect they would do it in such a way that you will observe them doing similar things where they don't try to overwhelm the market by issuing everything all at once. And the one thing that I did, in my paper studying, the impact of supply, which I'm a little bit proud of, is that people often look at they look at some sort of just simple correlation of treasury supply and then the interest rate. But what I was uh, figuring out was that really what matters is not the entire stock, but the treasury issuance. And not only is the treasury issuance, the new issuance that matters, there is actually anticipation, right? So when I calculated the weighted average maturity, weighted average duration of issuance, I was actually going 6 or 12 months ahead. So I was blending trailing 6 months and future 6 months, or looking at outright future 6 to 12 months, because the market anticipates supply that's coming. and it's being very painstakingly communicated to them, and in fact taken as advice from the market participants, primary dealers, right? So it's not like, it's very rarely the case the market would be shocked by supply, and I think the only time I remember most recently was middle of last year, Q3, right? From August through November, I think the market was just a little bit asleep on the whole issue because it hadn't thought about it in such a long time, that when it suddenly came up, even though it had been sort of repeatedly told about it, you suddenly, was a little bit surprised by it. But after that, I think very quickly you realize that like QRAs stopped being a market event informationally, like that day doesn't carry particular significance before and after if you do some sort of event study, right? Because the market generally anticipates and sort of smoothly adjusts towards it. So I would expect something similar where, sort of generally the fiscal picture is not pretty, and you would expect, supply to have that, I think impact on bond yields, driving bond yields higher, at least sort of always, I think, keeping, being a force sort of pushing bond yields higher, while other forces may want to push it down, right? If there's a recession demand or whatever. But I think, fortunately, supply is actually a choice variable. So I think they would do it, judiciously, so that the market doesn't go crazy.
Yeah, why do you think it was that the quarterly funding announcement mattered so much in 2023? That's the QRA, commonly known as just the simply the refunding. Because yeah, I think in that second quarter refunding, Treasury said we're going to borrow a lot more in the longer term. That long-term interest rates went up as high as 5%. I think they probably peaked October 30th, and then November 1st, the Treasury came out and said we're actually not borrowing as many. We're still borrowing tons of long-term money, but just way less than the market thinks. And then interest rates shot down, and the 10-year went down by over 100 basis points in like 30 trading days, so 1.5 months basically. And I mean, you could say that's just a coincidence, but it sure didn't seem like a coincidence, and I know many people were paying attention to it. So why do you think the QRA mattered in 2023, given that the year where you had the stock bond sell-off was 2022, and actually in 2023, I mean, bonds kind of sold off as stocks rallied a lot, which is a negative correlation, which is they are a hedge for each other.
Yeah, I think part of it, economics, there's this thing called the peso problem, right? Sort of, like the thing that goes horizontally and then suddenly drops, instead of adjusting continuously towards an event that is there, right? So the market has always known with quite a bit of foresight the borrowing needs was going to be there, right? And whatever borrowing maturity structure was going to look like, as of end of Q2. I think the market as a whole just wasn't really paying a whole lot of attention to the issue because it had just dealt with SVB and all these other things. Bob Shiller has this great book called Narrative Economics, right? And market sort of goes from narrative to narrative. Over the long run, I think things price out correctly in equilibrium. But in the short run, from week to week, month to month, there's always a dominating narrative, and at that moment, suddenly, this became the dominating narrative. And I remember, the 10-year yield went up 100 bips, from end of that eventful QRA, right at the end of Q2, and then if you take a different your favorite term premium estimate, term premium went up about 60-70% of that, right? In other words, a lot of it was actually driven not necessarily by a change of view about the long-term interest rate short path, but rather by risk premium compensation for absorbing bond supply. Which I think interestingly, Powell was asked about it, and he actually affirmed this viewpoint as well. That you can see how much long-term yield went up, and measures of term premium went up. So I think this really came as a result of depending on the quarter of the year, whether inflation was or was not a major consideration, right? Because you remember when the 10-year yield then soon after that third quarter thing plunged, very quickly because that issue narrative got taken away a little bit, And most recently, I think last year, when the 10-year yield suddenly plunged from 4.5 to 3.5 or 3.6 or whatever, because we had a growth scare. Nobody seemed to suddenly during that moment, just like nobody was talking about supply anymore, right? Or QRA, because it doesn't seem to take a whole lot for recession fears and demand for safety, demand for a safe assets to come right back. So I guess the long short of it is, I think that whole event was more of a narrative, having caught on, and then
Narrative.
kind of
The financial world definitely does run on narratives. Steve, the final thing I'd like to ask you about this is you got this fascinating chart going all the way back to 1920 showing
Mhm.
but the weighted average maturity of the U.S. debt in different colors: orange for short-term bills, green for 1 to 5 year, pink, red for 5 to 10 years, and blue for 10 and above. And then you've got a red line of just the weighted average maturity overall.
Mhm.
And it's fascinating how since 1980 or probably 1977, I guess, basically the weighted average maturity has been going up. And then from 1920 to 1970, late 1970s, it was going down. So it really is like two different regimes, and we are in a regime where the weighted average maturity is going up. So although debt to GDP has been going up, and that chart looks a little bit scary, and has many people saying a U.S. debt crisis is coming or something, it is notable that we do the term structure of our debt does not look like Argentina or an emerging
No,
market. It
not at
actually
all.
is quite responsible.
Yeah, if you
Or
look
what
at
do I
that chart 2.1 of that paper you're
Yep.
just referring to, which I will put up right after, I would refer to those regimes at the transition as being financial development or maturity, right? The US had gone from, a relatively financially immature country or less developed country to one that's really mature and institutional, right? Uh, um, and that the first half in the shaded area where you see a sharp and steady decline in maturity is exactly that the market is able to handle liquidity better, right? It's able to handle sort of transactions of large volumes of T-bills and short-term maturity. And generally, I think you see this in the entire economy, right? The U.S. financial sector, financial services being the world's most sophisticated, is going to be able to handle, sort of better, rollover risk better, right? I mean, it's all about risk management ultimately, right? So if you have the mechanism, you can take more risks. And since I think the modern era, you've basically seen the weighted average maturity to be what is statistically known as a stationary process, where it sort of goes up sometimes and comes down. Sometimes it looks like a sinusoidal curve. And that evolution has more to do with business cycle and various other structural forces. Sometimes it's a little bit higher, sometimes it's a bit lower. And right now we're actually towards the longer end of the historical range, which is good, right? Because you happen to be dealing with a lot of interest rate risks. So we have a debt. We seem to be looking at a debt portfolio that's relatively well positioned, that is not sort of stuck with having to go to whatever the highest sort of short-term interest rate is every 3 months. So
That makes sense. One thing that does give me a little bit of worry is just I think there's a lot of leverage in the treasury market, and a lot of treasury is owned by banks, which are leveraged, but also hedge funds, which are borrowing heavily in the repo market, as well as involved in the basis trade. So this issue is a little more complicated. Steve, let's now take a detour. Tell us about the index work that you do for Bloomberg, as well as what the products that you've got out. What are you working on now?
so my work currently is actually quite different from my work, on the treasury market during my PhD, and I work more on indices, investable indices, especially systematic equities. And we've worked on various thematic factor ideas that leverages Bloomberg's proprietary, as well as just I think accounting data. And I've tackled a few issues that are, I think, pertinent to the market over the last few years. Most recently, I put out a new white paper on in the innovation factor, where I think about how to systematically capture innovation. People love talking about innovation, but it's actually not often, I think, clearly spelled out what innovation actually means and how you actually go about systematically capturing it. So this white paper that I put out, which has a linked index that has been licensed by First Trust as an ETF, essentially looks at the R&D expenditures of public companies, U.S. public companies, and see which companies are genuinely innovative. And one core finding that we have is that, contrary to the past, where people have looked at R&D spending, as a source of innovation, we find that it's not so much the level that matters as much as the persistence. As anyone who has actually tried to do innovative work has probably knows, or even just work of any kind, that sometimes what really matters in the long run is having the persistence of doing it again and again. So if you screen companies that have, say, 3 consecutive years of R&D growth, regardless of anything else, right? Just do nothing else at all, and you take the top 100 companies in the U.S. large mid cap, right? And you sort of they take those companies and you market weight them, and then I guess you apply a little bit of weight cap so that individual companies don't exceed 8% or something like that. That gets you close to the benchmark weights. You recover a line, and that line, I'll let you guess what that line looks like. It looks like an index that everybody knows of.
The S&P?
The other one.
Nasdaq.
Correct.
Okay.
It overlaps the Nasdaq, which is kind of interesting. So there's a blog that we can link to. So basically, the Nasdaq index, of course, as we know, is just all the companies that happen to be listed on the Nasdaq exchange, right? And here we have, constructed mechanically, through accounting variables without referencing any stock exchange, something that looks just like it. In fact, as most recently, has actually outperformed it because it contains companies that are not listed on the Nasdaq exchange. There are innovative companies in the U.S. that don't list on the Nasdaq exchange without taking a dig at Nasdaq exchange at all. Like, we know that, for example, Eli Lilly, which is a major pharmaceutical innovator and one of the inventors of the GLP-1 drug, happens to be listed on the New York Stock Exchange. So this is actually something we find that basically persistence, works better than intensity, right? You can screen for companies with the most intense R&D spending relative to, say, normalized by sales, but persistence just has historically done a lot better, and this is actually true not just in the U.S. large mid cap, but in the U.S. Different market segments as well, mid small cap and overseas, right? So that's interesting fact. But then we also go on to sort of actually concretely verify why this R&D actually is innovation and not just some sort of luck.
When did you publish this index?
This index was published, I think, early last year.
Okay.
I think late 2023 actually, and then became licensed, by First Trust.
Got it. Yeah. So the ETF has outperformed the Nasdaq since it was created. But it was created in May of 2024, so it's been out for less than a year. What is the index done like before?
Exists before then. Yeah.
Yeah, but the index has existed before. And tell us about what the index has done since you created it, as well as what the index did historically. Although that is an out of sample thing, and you created it before you did the outperformance.
Yeah. So. As I was saying earlier, right? I think historically, this index has looked a lot like the Nasdaq, index, because it captures a lot of the similar names, and we all know how tech and innovative companies have done, over the last 20 years, especially most recent 10. And part of the reason we have seen this dramatic outperformance is actually not because market has just gone into a bubble and mania and so on. If you look at the fact the footprint of the companies that are in this index, you'll find that you overwhelmingly load on quality and growth. Obviously they're expensive, but these are companies that are highly profitable, right? I think what we are seeing is essentially the capitalization of successful innovation in America, uh, and I find it quite fascinating that there was this book in the '90s called The Innovator's Dilemma, right? And the author Christensen, he wrote that over time, as companies get larger and larger, they find it difficult to innovate. Why is that? It's because whatever new line of business they discover, right, even if it succeeds, it doesn't make a immediate first order difference to their overall revenue, right? Because it tends to be a very small business, and if anything, it may actually cannibalize their current business. And then you have other factors such as bureaucracy and other issues that tends to prevent companies from innovating. But what we saw over the last 20 years in the US is that not only has US managed to continue innovating, but innovation has actually occurred a lot at very large cap companies. So much so that today we're talking increasingly about Magnificent Seven, the Fang, and so on and so forth. These companies, on the one hand, they are dominating the markets, with very expensive valuation. On the other hand, they've also just become, indispensable in society because they've come up with genuinely valuable, innovations that are very, very profitable, and customers pay for those things. And to the extent that the index that we published has actually deviated and outperformed, sort of say the Nasdaq index, is because this is actually done in a systematic fashion. So we actually pick up companies that may or may not list on the Nasdaq exchange, but qualify based on the signal.
And oh yeah, 3, 2, 1. So you're basically capping up companies that spend a lot on R&D, but are profitable and been having spending money on R&D for a while. So it's probably not going to get stocks that just IPO'd. So what would an example be of a company that is in the Nasdaq but is not in your R&D index? And what's a company of example of a company, you get to say a generic example of a company that would be in your index that's not in the Nasdaq?
So I gave an example earlier. That's, I think, a pretty famous one. That's the Eli Lilly,
Yeah,
right?
yeah.
Eli Lilly, happens to be listed on the New York Stock Exchange. There is also Caterpillar. That's another one. People don't think about industrial companies; they're not sexy, right? But Caterpillar is actually a very innovative company. And if you go further down the market cap, you start looking at companies like Snowflake, Block, Square, right? So there are companies that are not necessarily listed on that exchange. Credit to Nasdaq, they sort of really were very early on, capturing, became the home of tech companies, innovative companies, and there is a snowballing effect. But the broader point is that is not necessarily exclusive. Good ideas, innovative ideas, is not necessarily exclusive to a single stock exchange.
And so yeah, I guess the Nasdaq, I think Nasdaq 100 is 60% tech as we record, whereas your index is much less tech. It still has a lot of tech. So you're capturing innovation that's not in the technology world as well. Yeah, tell
Healthcare.
us about sectors, because sectors are kind of aren't they they're kind of nonsense. I mean, like Amazon is a tech company, but it's in consumer discretionary. Let's see, Google is it's a tech company, but it's in communication services. Like these, I guess, telecommunications. These names, I mean, do these sectors, do they really help? Do we think we need a either get rid of all the sectors, rid of all the labels, or generate new labels? Because often they say, oh well, we're diversified. We don't even have, we're only 40% tech. But then the thing that's not tech is Amazon, which is not tech technically, and Google, which is not tech. technically.
Yeah, exactly right. I mean, this goes beyond the scope of this index itself, but yeah, I mean, I think over time we come with new ways of modeling the world, right? Sectors are really just a broad type of categorization, and people, once you start thinking about it, indeed, right, like, why is one company designated tech and not the other one? And then over time, actually, companies move too across sectors, because if you really get into the weeds, in the sausage factory, you can talk to our colleagues in the BIGS, on the BIGS team at Bloomberg Industrial Classification System, um, that it has a lot of what judgment calls about what percentage of revenue is derived from what source, qualifies you for what sector. So yeah, it's quite right. And then, of course, there's emerging patterns in new industries, right? EVs and drones and new things coming out all the time. And old companies may try to get into new sectors. So it is hard to say, but I think as a broad categorization, sectors, categorization kind of gives you a sense, right? I mean, just like we have different style factors now: value, momentum, quality, and people can debate whether a company is necessarily one versus the other, and depending on the intensity. I think they're just sort of approximations.
Mm-hmm. And Steve, because spent so much time talking about indices, I want to ask you, what do you think about the S&P 500? What do you think about these passive indices? Why are they so hard for active managers to beat? Why is it that these seemingly kind of arbitrary rules of, okay, you take, I don't even know what the S&P 500 rules are, but I guess they have to, I guess, be kind of profitable sometimes. They have to be a certain size, and then you kick out the people who are smaller, and so that's the way how Tesla gets in, and Super Micro gets in, and you get things reweighted. But ultimately, the principle is the better the stock performs, the bigger it is as a percentage of the index, and you don't do rebalancing. You don't say, oh, Apple's gone up twice more than my Intel, so I'm going to sell half my Apple and rebalance Intel. You don't do that. It's market cap weighted. So tell us, just and that has done very, very well in the U.S. Part of that is we've had a bull market in U.S. stocks. We've had a bull market in large cap tech stocks, so that has worked. But just tell us your overall thoughts on the S&P.
Well, let me actually stick to Bloomberg indices. So Bloomberg, we have a B500 index, which is basically the largest 500 companies by market capitalization.
Hmm.
And then there's some buffer rules around what gets in and out on a quarterly, rebalance frequency and review. Uh, but I mean, behavior, like if you plot the two lines, you will not be able to tell one from the other. They are very similar. So there is some sort of committee-based
Yeah.
discussion, I think, S&P practices, and because it's the most well-known and the most tracked trading index, there's sort of front running around those decisions. But by and large, what really matters is what's at the top. And with the market being so top heavy, like people sort of lose their minds over, like, oh, SMCI got added and you lost a bunch of
Mhm.
weight, and it seems to happen regularly. The thing is, it doesn't really make a first order difference at all to the level of the index, right? Because such has such a tiny weight as a new addition. Um, I think regarding your question about why it is that passive index has had such a strong track record, I think it's a fascinating question. I've pondered about that myself a lot. I think you've alluded to it, and I suspect that's a really big reason is that you just don't really have as many opportunities for the active manager to come in and meddle with and make a bunch of decisions that more often than not actually hurts, right? So you don't have the kind of like risk based rules where you have to cut some weights if the winner is running, and you just have this passive set of weights that's based on market cap, and so mechanically you are loading on momentum, right? And you are also going to, I think, have some based on rebalancing some means of mean reversion. But yeah, I mean, it's a fascinating question, why that is, and I don't think I can give you a full answer on spot right here. But I think you've alluded to a lot of the reasons.
Okay, so we won't talk about the S&P. We'll talk about the Bloomberg 500, which sounds like it's just the biggest companies. And I guess first of all, what's the name of that, and what's the difference between that and the S&P? I guess there's some companies that get big, but they're not allowed in the S&P until certain things happen. Like I remember Tesla wasn't allowed until the end of, was it 2020 or 2021? I forget, but there was a time where it probably was a member of the Bloomberg index. It got added immediately once it eclipsed the 500th biggest company, but then it took a while to get in the S&P. So talk about that, and yeah, I just I think we can mine this vein of a little bit more because there's a lot there.
Sure. I think that is an interesting thing, right? So, as you know, S&P 500 index is an old index that's committee based, right? And there is a certain degree of discretion as to which companies get added and deleted. And obviously, the reason they do it that way is because of legacy that's sort of been that way. But also, I think part of it is because it has become such a market event, which companies get added because of the passive holdings of these on demand for these shares, that there is front running and trading around the index reconstitutions. Um, Bloomberg B500 index, is fully rules based. There's no committee, right? And there's no
And it's just one rule. It's the biggest companies in the US or global.
US, yeah. And there is no profitability rules. For example, I think S&P requires that a company to be profitable consistently for I think 3-4 quarters in a row,
Yeah.
right? Before it's eligible to be selected. We don't have that. But beyond that, I mean, there's sort of, and then there's of course some buffer, so that companies don't immediately qualify upon being momentarily, sort of the top 500, for an instant, right? But beyond that is entirely rules based. I think this is actually I think a more in my opinion, right, the more intellectually consistent way to do it, because like to the extent that you just want a benchmark that captures the market, I really should not have to want to put another quality or profitability screen on it, right?
Mm-hmm.
Why do I care if it's profitable or not profitable?
Well, I mean, you put a quality screen on your R&D thing. I think you're all about quality screens. I think it does matter. What surprises me is that the Bloomberg no quality screen whatsoever. I mean, according to you, it has the same line as the S&P. That surprises me, and that tells me that maybe the added quality screen of adding the profitability is accounted for because once a company leaves the biggest 500, that is the quality company, and so maybe there's a lesson there that you don't want to own the company that just exited the S&P 500. That's not a good thing to own.
Yeah, I mean the thing is that it's not like a consistent quality screen either, right? Because it's not like Tesla,
Yeah.
only becomes eligible if it's profitable for a number of quarters, and then if it stops being
Yeah.
or if it loses money, then it gets kicked out. It doesn't get kicked out,
It's a
right?
quality screen to get in, but it's not a quality screen to stay, is what you're saying.
That's right. So the impact is actually pretty second order, if any at all, right? It's very minimal because of that, right? So, at least that's sort of how I see it. Um, and the R&D index, by the way, this is a different set of animals, right? I think Eric Balchunas will call them hot sauce indices, right? These are more akin to your sort of factor indices that are like value, momentum, quality, and so on and so forth. And I find this whole concept of passive indices rather intellectually unsatisfying. And what is actually passive about an index that's constructed based on sort of factor rules that gets rebalanced? I mean, fundamentally, how different is that from, say, a factor fund? So intellectually, I find the line between active and passive to be quite blurry, and I think of it as being more a continuum
Yeah.
than a clear cut.
True passive would be owning 500 stocks in some weight and then just never changing that ever. And
Yeah.
I actually saw this on Twitter, so I don't know, a year or two ago. I don't know if it's true, but actually, like the S&P 500, if you bought it in, let's say, 1965 and never reweighted it, that performance would it be even better than the reweighting of the S&P over then, which that is interesting.
Uh, well, you would have suffered mightily from survivorship bias, right? A lot of the companies would have gone bankrupt. I mean, part of the reason why passive index works so well is because, sort of you autonomously gets rid of companies that disappear, right? And pick up new companies.
Yes, I guess, but I guess that is pure passive. So again, it's something I saw on Twitter. I guess I wonder why that would have outperformed. I guess does the S&P ever like reduce its weighting on something because it's gotten too big? Does it ever do that or no?
I mean, increasingly, recently there is a debate about capping the weights of these biggest companies, in the indices, and that's actually a discussion that's been happening for S&P and Russell and so on. I think it's in response to the fact that you have such increasingly high concentration of
Hmm.
market weights because of the high capitalization of the biggest handful of companies. I think this morning I read that 26 companies account for half of the index weight, making basically companies that are towards the second half of the 500 names economically irrelevant. They can go up 10 times and you wouldn't even notice it at the index level. you
That well,
know
that's one company, the 499th biggest company. If it went up 10 times, you wouldn't notice it. But if 100 companies, 400 to 500, you would notice that, and then they become economically more significant. And the point is, it's because Apple's been such a great company, and it has been such a great company that they've earned the spot. They weren't given the spot by the geeks on the S&P index deck. They've earned that spot. So, but Steve, I mean, I did small amount of research into this, but I don't know how much you're familiar with like the telecom bubble in Canada. Like Canada famously has tons of oil and gas stocks and few tech stocks. So when they had this one tech stock, Nortel Networks, it was like 30% of the index. And when you
Mhm.
it ultimately had severe accounting issues of fraud. That the CEO had to resign. And so when you have a stock that's 30% in an index and it goes down a lot and has severe issues, that can suffer. But I don't think that the current S&P is as vulnerable as that, because Nvidia is 8%, Apple's 6%, Microsoft is 6-7%. These are high quality companies, and they definitely can go down a lot. But I do think that those companies are generally higher quality than the average company in the S&P 500 and averagely the Russell. So it's like if it's dominated by bubble stocks, then yes. But I'm not of the opinion that those stocks are bubble stocks yet. But I mean, what do I know? What are your thoughts on this matter?
I mean, well, two issues. I mean, it's interesting you brought up Canada, right? I think first of all, I think country boundaries are a little bit arbitrary, right? Like if you pick Saudi Arabia, it's going to necessarily be dominated by oil and gas, and Aramco is going to be by far the biggest company. And why do we actually draw national boundaries, and
Mm.
construct investable indices that way? Apart from the fact that, I mean, obviously you do have, sort of, national regulations and so on. Generally, I like to think of companies along come as much as possible universal characteristics, right? And to that extent, U.S. companies have just been over the last, however long, growthier, higher quality, more profitable, and longer duration. So I find these charts where they compare U.S. stock market performance with the rest of the world. Often I roll my eyes very hard because you're not really comparing apples to apples. Exactly as you alluded to earlier, the sectoral compositions are totally different between U.S. and Europe and Asia, right? And you don't compare growth stocks with value stocks. And for that reason, you shouldn't just compare directly. And if you adjust for that difference, equity duration or growth profile, you'll find that Europe and American stocks, the difference, the delta, while there is still some because the valuation premium in the US is substantially smaller, much smaller. Uh, so that's sort of my first point. Regarding your second point, I think this goes back to the nature of the U.S. economy. Right, it's a very large, complex, diverse economy that's almost a world unto its own. Right, the joke people often make about Americans, sort of calling baseball, National League as the World Series. There is something there, right? This is a country that is just really, really big with lots of stuff going on, and with all the sectors, with all the things that you want. So and it has the most developed financial sector. So the bubble, to the extent one worries about concentration of equity in the indices, passive indices, the B500, you see a similar high degree of concentration towards the top. Really, in my opinion, is mirroring a bubble, quote unquote, in the real economy, that you have a increasingly winner takes all
Mhm.
economy,
Yeah.
right? Instead of a mean reversion economy, right? The sectors that are dominating are sectors that tend to be extremely high positive network externality, social networks type of economy where Apple's sitting on top of the most valuable set of users in the world to which you can deploy the latest technology at the a snap of a finger, right? So I think that is really the more interesting question. So rather than focusing on how much market cap and market index weight a certain company has, I think the more interesting question is, should we expect, right, this evolution, right, of network externality to continue? Can we keep expecting Costco to kill off local mom and pop grocery stores, and everyone just shop at Costco and use an iPhone and do everything with Nvidia chip driven AI applications? Like, is that the world we're going to live in? Or should we expect at some point some kind of mean reversion and the small guy strikes back? You know?
Right, and I think that like so much of the earnings growth in the S&P 500, it may be literally over 100%, has been from the Magnificent Seven. So when people say, I mean, have you seen what the Magnificent Seven stocks are doing? And the Russell hasn't even moved. It's like, yeah, the small cap stocks are their earnings are contracting, and the
Correct.
large cap stocks their earnings are growing. So stocks that have growing earnings should be going up, and stocks that earnings are going down generally should be going down. That's how it kind of works. That being said, you did mention Costco. I think
Mhm.
the earnings there have been growing a ton. They have been taking market share away from mom and pop, but I think the price to earnings ratio there is nosebleed levels. I mean, 50 PE for a grocery is
I've been telling people what we're witnessing is a quality bubble,
yeah,
right? It's is you are seeing the simultaneous expansion of earnings of very quality being a factor, right? So like profitable, low debt, low leverage, and low earnings variability, strong pricing power
yeah,
companies. These companies are being bid, right? And they have been bid in the low rates era. They were being bid as though they were quasi bonds, right? Because you have low interest rates and everyone wants to earn a bit of earnings yield. And now I think it's just, I don't know what's driving it all, but you're sort of seeing their valuation really go up a lot. And going back to what we were saying before, like, this does not feel very sustainable. But if, let's say, we get a major correction, like, what is the next thing you'll buy? I don't know if you wouldn't just run straight back to these things that's at a lower valuation. You know?
right. Yeah, I think if 2020 and 2021 was a bubble in junk speculative growth stocks, 2008, I mean, the bubble was mainly outside of the stock market. 2099 bubble in .com stocks, growth stocks, but that really didn't even have any revenue, extremely speculative. Now it's just good companies are priced extremely richly. But I
Mhm.
think a correlate to that is that there are high quality companies that are growing that are like I think the worst saying of all time is it's a stock picker's market because it means nothing. But there are opportunities where I feel like in 2020 and 2021, like most stocks, just all stocks were overvalued. Where I feel like now it's quality stocks or perceived quality stocks are overvalued. Steve, any response to that, or just what else you got? What else are you working on at Bloomberg Indices? What are you cooking?
Yeah, so related to what we were just talking about, so we have this, innovation index, but we also previously have created two other indices that I want to mention quickly. One of them is called the pricing power index. Related to what we were just talking about, Costco is a consistent member of that index, and we wanted to systematically capture companies with pricing power. And we found that it turns out you can find companies with strong pricing power by looking at the stability of their gross margin over the trailing 5 years, right? Companies that maintain extremely stable gross margin tends to be companies that have very strong pricing power. And interestingly, they tend to have a certain profile to them too, right? So economic logic wise, why is that the case? is because a gross margin is basically the closest thing to the top line, right? Everything is basically top line revenue minus variable costs, which includes all your input as well as hourly wages, right, of your temp workers. And a company that has very stable gross margins comes in on two ways. Either they see their cost increase and they pass on the cost by raising prices and maintaining gross margin, or if they see a surge in demand for their products, right, and gross margins going up, then they will supply into that additional demand, right? So what you find by doing such a screen is that you see companies that tend to be niche suppliers in suppliers in niche industries, of which there are a few handful of them. So interestingly, you pick up recently a lot of the AI stuff. Sort of Cadence Design. Is a company that gets picked up because they design software for designing microchips. So things that is not very.
Sure. Yeah, that pricing power index. So it's interesting. I expected to see a lot of the top names. I mean, Apple, Microsoft, Nvidia. I mean, what company has more pricing power than Nvidia? I mean, if Apple wanted to charge, $1,500 for their phones, a lot of people would buy it. But those names are absent. Why are those kind of Mag 7 names absent from the pricing power index? Whereas for the R&D one, like I said, it looks a lot like Nasdaq. Was it intentional, or is it just that your weightings dictated that nope, these don't qualify because it doesn't meet XYZ weighting?
Yeah, that's an excellent question, right? So these are systematically constructed indices based on systematic rules, right? In the case of pricing power, is based on the stability of gross margin. In the case of R&D, is based on the persistent growth in R&D expenditure. So whatever comes up, right? So why didn't Nvidia come up, and why isn't Apple there, right? First of all, Apple will be there if you expand the list to a bigger number of holdings. We happen to be picking the top 50 by pricing power.
Mhm.
Apple, if you think about it, does Apple really have strong pricing power in terms of its iPhone? The iPhone flagship price has actually not changed very much over the last few years. If you look up, the iPhone, a Pro or whatever, right?
Yeah. I guess I'm out of date. I thought that the iPhone now costs like $1,000, and I remember it costing, $100 or $200. But maybe the price went up from 2008 to 2020, but over the past 4 years or now 5 years, you're correct in saying that. I mean, I know Warren Buffett has said that Apple has pricing power, and basically he's saying, if people charge $1,000 for this, it adds a lot more utility to their lives than $1,000, and perhaps he's right about that.
Apple absolutely does have pricing power, but if you think about the last few years, when you just said that the flagship phone's price has not changed very much, that was also during the year in which costs went up a lot, right, because of inflation, right? So Apple's margin actually suffered while they kept their price the same in order to maintain market share. So but Apple is also trying to pivot towards services and so on. So there is a reason why mechanically Apple is not picked up. Nvidia is another interesting example in which the gross margin stability was not there. In the case of Apple, the gross margin went down, right, and therefore not stable. Nvidia's gross margin went up a lot, right, and stayed up, right, and it kept inching upward.
I mean, it's ridiculously high gross margins for Nvidia.
Right, correct.
7%.
80% gross margin or whatever, like half the cost if you're running an AI company is going towards Nvidia. So so why did it not get picked up? I think this is one of those cases where it's a false positive, right? So we want to construct a simple signal that serves as a sufficient statistic that picks up most of the correct names, and you may miss out some sort of names that should be there, right? So in this case, I will struggle to find companies that have a unsustainable short-term surge in gross margin that don't really have pricing power, right? And in Nvidia's case is really more of a unique set of circumstances where the surge of gross margin has shot up and stayed up, right? And let's see what happens in a few years. If let's say they keep this up in 5 years, it will show up in the index. But for now, it just has not, I think, shown that level of stability. Who knows? So this is one of those cases where you do sometimes miss out on a couple of things because you're not able to quite perfectly differentiate the true and the sort of zero and the ones.
Yeah, I do not expect Nvidia's gross margins to stay at 76%. I don't think anyone should expect that. If they expect that, they'll be disappointed. And if gross margins for Nvidia do stay at 76% for
Yeah.
the next 10 years, then no one owns enough Nvidia. But that's not my
Exactly.
expectation. Steve, I mean, we talk more about what you're working on, but I'm sure you see a lot of indices created by other people.
Mhm.
What is kind of your pet peeves in terms of indices that don't make sense? I'll give you a few examples. One could be the Russell,
Mhm.
where it's all small cap stocks. So basically, the good stocks in the Russell that go up leave the Russell. That's a kind of a problem. And then another example would be the Dow, where it's price weighted, not market cap weighted. So the biggest stock in the Dow was United Health because it didn't do a lot of stock splits. It was bigger than Apple, and that stock being down hurt the Dow, which was I think it's why we had what 9 or 10 days in the Dow being down in December. So I mean, those are two examples that come to mind for me, but I'm sure you have much more high level examples. Like, what are some things you see in the index worlds where it's like, this is wrong? Because I know on Twitter, Steve, you often you like to be a little bit critical, and critical is not a bad thing.
Yeah.
Like art criticism, movie criticism. It's how we improve. But what are some criticism that what the index criticism? What is Steve Ho has a weekly column called Index Criticism? What's he writing about?
So yeah, great question. I mean, first of all, to address the two indices that you mentioned, I I actually think the Russell one gets, I think, unfair rap a little bit because going back to what we were saying before, there is actually a strong correlation between size and quality. Historically, has always been the case. There is this very famous or infamous paper by my former employer AQR's, folks. That titled "Size Matters If You Control Your Junk."
Mhm.
I won't explain why it's controversial, but basically what they find is that whereas historically there was like at the beginning, dawn days of factor investing in the 80s, bands found that small cap stocks tend to outperform. You sort of that went away, right? And you actually see a strong correlation of junk quality and small cap, right? Small cap companies tend to be less profitable, often unprofitable, and large cap companies tend to be sort of the opposite. And I think that has only worsened based on what we just were discussing, right? There's a structural advantage of being bigger increasingly, right? That so much so that the biggest companies almost are no longer constrained by macroeconomic forces because they generate so much profits and cash flow, they don't really need to borrow. Whereas small companies are often highly levered and they get hurt by high interest rates, they get hurt by everything, right? So but the thing is, what's curious about it is that you would think that, well, first of all, small companies become big companies. That's how big companies came about. They start small, they start as a startup, right? So if you think about it in a rational perspective, you expect small companies being junkier, be priced cheap enough in relative to earnings or whatever you want to measure, such that the expected returns should be high. And on average, that they should earn higher returns to compensate investors for holding these, sort of
Mhm.
companies that are awful to look at. But that has not been the case. In fact, we've seen quality kill it, right? Quality has earned. So you have this situation where over the last 20 years, or maybe longer, easier to hold companies that have low volatility in earnings, low volatilities in stock returns, high profitability have done better. Whereas the companies, junkier companies that are not profitable, small cap companies have absolutely languished, right? Over the last, however many years, is say 7, 8 years. If you plot the, small cap index versus the large cap, you will see that yawning difference. But if you take a longer horizon, you do see periodically, right, sort of like small cap outperform, right? So I think some of this is also recency bias and structural changes in the macroeconomy. So I don't really think there's anything particularly wrong with, constructing indices based on, a small mid cap segment. You just have to sort of, I think, be careful about how you control for quality. And in fact, I actually show that in the R&D index white paper, that small mid cap segment until basically 2021 or so, innovative companies in the small mid cap segment have actually outperformed, right, the large mid cap version. So it is, so small cap is not necessarily a problem. The Dow's, I think, that's more historical legacy, and people like to cite it, but there's not a meaningful amount of asset that's linked to it anymore, right? So it's just whatever.
Yes, but when on CNN or PBS NewsHour, any non-specialist financial program, basically any news that's not CNBC or
Yeah,
Bloomberg or like a financial program like
yeah.
itself, quotes the Dow a lot. They say what the Nasdaq did. They say what the Dow did. They say did what the S&P did. Often they cite the Dow first. So most Americans and most people, I think that the Dow matters, even though you're probably correctly saying that it doesn't matter, and we both agree that it's kind of a silly index.
Well, what is interesting though about the Dow, and I hope soon we'll actually start quoting the B500 index.
Yeah, say it's the
From
B500. B500.
B500
B for
B,
Bloomberg. Got it.
right? I think the Dow, interestingly, has a bit of a value tilt. That's why on any given day you will see that if sort of Nasdaq is doing well and Dow is not doing well, it's probably the case that growth did very well and value didn't do very well, and then vice versa, right? Sort of on the days when Dow is doing relatively well and Nasdaq is down, is usually the case that value has had a good day. So I mean, as a proxy, I think that's probably a tangential purpose it still serves, apart from the fact that it's just based on familiarity.
Hmm. I've got a question, Steve. And this may be before both of our time. It actually definitely is before both of our time. But I know that part of the reason why the Russell has been performing so badly, in my opinion, is because there were so many junk companies that went into the Russell because there's an IPO boom in 2020 and 2021. I just looked at the IWM and the Russell in 2000, and the recession and the dot-com bust. The Russell was only down like 25%, whereas the S&P and the Nasdaq was down way more. So is there some kind of quality control on the Russell where, like, how come all these bubble stocks like Pet.com didn't go into the Russell? I'm assuming they didn't go in because if they did, it would be down way more than 25%.
I don't know the rules exactly. I suspect my suspicion is that there is a similar set of rules, but then the structure of the economy itself has changed such that you very often see companies that stay private for a long time and then they becomes public and then almost instantaneously gets upgraded to large cap. Like Airbnb is a recent good example, Uber and so on and so forth. I think there's that structural change in the economy. And then attendant with that, there's a sectoral change, right? So you increasingly have a lot of smaller, so unprofitable biotech companies that are, sort of found often in the small cap index. Their exit strategy typically is they have a drug and they don't have any revenue. They just keep working on the drug and eventually get bought up, by one of the large pharma companies. And they don't really graduate to become from a kid company to an adult company. Instead they just sort of get acquired. So I think, again, we'll go back to what we were saying before. I think what we are seeing in the financial markets is actually mirroring the structural changes in the real economy. And I don't know what was the explanation. We'll have to go back to look at the sectoral composition and the type of companies that were held in the Russell back in the dot-com era. But I suspect, like, to the extent that you had this pet.com companies and whatever, they probably were not, massively included.
Mm. Steve, I know you spend your days focusing on indices, not necessarily macro, but what is your macro view right now? How are you thinking about the performance of the U.S. economy and just asset allocation as well?
Yeah, that, I mean, it's interesting. Like, I don't explicitly think about macro, although macro does, I think, guide my even thinking about design indices and the type of things that actually matter for investors. To the extent that one thinks about the last 20 years and the persistent deficits the U.S. government has run, right? That may in part have had some big contributing effect on the profitability of U.S. companies. Maybe that's actually a driving factor behind the quality factor. Why it has done so well. Now, 20 years later, starting from Clinton's surpluses, people worrying about maybe the Treasury or the Fed will run out of Treasury securities with which to conduct open market securities, to now we have a world of debt, right? And you have Doge trying to deal with government deficits. Clearly, we are in an environment where sort of stock bond correlation fluctuation notwithstanding, bonds are just becoming much less desirable, assets, right? So from an allocation perspective, you're thinking about is whereas previously you'd be comfortable with a simple 60-40 portfolio where stock and bonds mutually sort of diversify each other. Now you think about maybe adding in things that would actually help you, form a better set of correlations. That's
Yep.
kind of
But Steve, the 60-40 portfolio, like the 10-year bond, it has to be more attractive relative to stocks now than when the 10-year bond was at 70 basis points in 2020, right? It just has to be. I understand the correlation point, but you're just earning like the 400 basis points higher.
I mean, I don't know. People were very eager to buy bonds when yields were at zero.
I
Now I
know,
know
I know.
what I mean, I was recently. I mean, you had Citrini on, and I spoke with him a little bit, and he was making this interesting point where he said, "Oh, like the 2022 experience and the Fed hikes kind of broke the bond market, broke bonds as an asset class, because people suddenly have had experience of being burned by bonds, right? Having this massive drawdown that I've had in decades." No, I mean, look, I think bonds are certainly still going to be there, as part of the asset allocation, and you clip a coupon, and the bond yield is going to be high enough to justify, right, whatever risks market is going to be in equilibrium. So, and you're just going to have whatever correlation it's going to have with stocks. People are still going to want to hold bonds because outside of long only beta context, there's nothing else you can hold that can protect you in a deep deflationary recession. If we, God forbid, like have a bad recession now, inflation is going to plunge, and suddenly there's not going to seem that it would seem like there's not enough bond to go around, right? So people are still going to want to hold bonds, but I think if you look at that chart that I've shared with you previously of the stock bond correlation, how it has actually co-varied over the last, sort of half a century or more. I mean, like until 1990 or 2000, stock bonds were generally positively correlated,
Yeah.
right? And the next 20 years, it's been negative correlated. And now we sort of spike upward, to positive, and we are sort of like, fluctuating a bit. But my suspicion is that we're going to find ourselves, meander ourselves eventually towards a definitively positive territory, right? Where
between stock bond correlation, meaning that as stocks sell off, bonds sell off, as
correct,
stocks rise, bonds rise.
correct,
Yeah.
correct. And the reason that is because fundamentally what undergirds this regime is the salience of inflation, right? Because inflation, if you think about like from asset pricing point of view, golden formula, right? Like you are discounting cash flows, future cash flows by some discount rate to the present, right? Inflation enters as the discount rate, right, in the denominator, right? So it's going to move both stock and bonds at the same time up and down, right? Because nominal bond, the coupons are fixed as a fixed number, right? So when the discount rate goes up, bonds go down, right? Whereas stocks, it has numerator and denominator, right? And the numerator, if the inflation is very low or generally muted, the cash flow component can dominate such that bonds and stocks move in the opposite direction. But if inflation becomes first order and is always on the back of people's minds, then it's going to dominate and move stock and bonds in the same direction. And I think that's what we're going to see over the next, however long, that we are in a, in my opinion, modestly, generally inflationary environment where I don't expect us to go back to the 70s by any means, but I also don't think that in the absence of the types of structural positive supply shocks that we saw coming into 2000 with China entering the WTO and automation, and then we also got hit by a GFC, that you're going to have inflation really come down that much. I mean, the Fed can only do so much. Ultimately, you need something else to take over, and whatever is taking over, I think, is going to be a generally more inflationary, set of factors. But of course, that's more secularly the case. Cyclically, we could very well go through a further, few months or to a year of further disinflation. Who knows?
We'll link in the description your first paper for your dissertation, when is the supply effect large in the government bond market, as well as your hopefully your second piece, a realistic model of US Treasury debt management. Steve, people can find you on Twitter at SteveHoF. Where can people find you? Where can people find the work of Bloomberg Indices?
They can go on to BloombergIndices.com, and we should put a link of all of our research pieces, at the bottom of our chat today. And yeah, I look forward to people reaching out and chatting about things we've discussed today.
And so what's that link? Bloomberg.com. What's the link?
BloombergIndices.com.
BloombergIndices.com.
Yes.
Indices.com. Got it. Cool. All right, Steve Ho, thanks for coming on Monetary Matters. Thank you, everyone, for watching. A reminder, people can find Monetary Matters not just on YouTube, but on Apple Podcasts, Spotify, wherever else they get their podcast. Until next time, thanks again.
Cheers.
3, 2, 1. All right, I'm here with Steve Ho. We just finished wrapping our over 90-minute interview. It was very good. Talked about term premia, talked about his work he does for Bloomberg Indices, index construction, all very good. After we finished recording, I asked Steve a simple question. Does he think the 10-year is a buy? If the 10-year hits 5%, it's now at 4.7%. Does he think the 10-year is a buy? He starts to go and talk about something very interesting, how he thinks bonds are a buy, and we're going to have a repeat of a dot-com bubble. I couldn't help myself. I started yelling at Steve. I said, Steve, this is such great podcast content. How dare you, hold this in for 90 minutes and only start saying this after we start recording? So I had to turn the cameras back on. Steve, the floor is yours. Dot-com bubble, go.
Yeah, so I have a nuanced view about 10-year and I mean, I already gave you why I think secularly, I think bonds as an asset class is bearish because of macro forces and with all the uncertainty supply. But I think cyclically, what's going on right now, I increasingly see us in an environment similar to what we witnessed just during the dot-com era, right? If you recall, in 1998, in 2000, between that period, the Fed similarly cut interest rates 3 times, paused, right? And eventually had to resume hiking, right? And during that period when the Fed paused, 10-year yield surged, right? And stock market surged even more, right? Market went berserk, right? And of course, what eventually followed was a stock market crash and a recession. During the recession, the 10-year obviously yield fell a lot, as with inflation, as it does during every recession. I mean, the reason I didn't mention it before is because this will feel a bit too, I don't know what's the right word, in any event, it's highly speculative, right? But I increasingly find myself thinking that we are going to have a repeat of the dot-com playbook, where the Fed almost becomes a little bit of a secondary, player in this whole show, whereas the previous 20 years that it was all about the Fed. Increasingly, I think it's going to be increasingly not about the Fed, and other sources of other macro factors will come to dominate market sentiments. In this case, clearly what's been happening over the last few months since the election has been Trump, right? The new administration, everybody is just projecting their wildest dreams, the most bullish expectations on the Trump, the blank canvas, ignoring the bearish factors. And all the Trump-related trades, which I think Srini has discussed with you plenty on your previous episodes, have just gone absolutely parabolic, and in fact stayed parabolic. If you look at the overall index as a whole, we actually retraced a lot of the gains post-election. But if you look at the names that are intimately related to the various Trump trades, including, of course, Elon's, Tesla and sort of BFF stock, it has actually not, almost doubled, right, from before the election, and is retraced a bit. I don't know what the market is doing now, but it has actually held most of the gains since the election. I think that's true for a lot of the sort of names. And then, of course, it's the AI stuff. And I just think that, you can have an environment where the stock market mania gets so big that it trumps the discount rate channel. Now, if you think about the last few bubbles we have had, right? Dotcom bubble was about internet and proliferation of connectivity. 08 was about the U.S. real estate market, and the subprime lending thereof. And then you had fast forward to 2021. That was, 2021. That's COVID initially, and then liquidity, and then crypto junk rally. Now, what is the bubble now, right? I mean, sort of apart from the previous, sort of run up in quality, valuation expansion, we're really talking about an AI bubble, right? AI and evaluation and robotic automation bubble. Now, if I ask you out of the blue, does AI as a theme deserve to be the biggest, greatest asset bubble in human history? Right? Because if AI works out, if AGI really is a thing, kind of none of what we do matters, right? So you have this fundamental uncertainty that's to be resolved, potentially with the upside, right? And while we are still resolving this uncertainty, that's what makes me think that this has the potential, thematic potential of being the greatest asset bubble of all time, right? And against this backdrop, you can have, sort of other macro forces that are unfavorable. Inflation, let's say, it ticks up a bit, right? 10-year yield ticks up a bit, unless we get something where inflation is literally going through the roof like what we did 70s. Like rates were really high during the dot-com bubble too. And you can look up the 10-year yield. And inflation was a bit lower, but inflation was turning around, right? So anyway, that's what really gives me the intuition. And the more we see market, sort of melting up like this, unrelentingly, we sort of took a little pause, during Christmas, but then we are very much resuming that, right?
Right. Yeah. I'm not a technical analyst. I don't put much stock in technical analysts, to be honest, but just looking at the technicals of the market, like breadth is weak. It is getting narrower and narrower. And what people said a year ago about how breadth was weak was BS, but it actually is true now. Like most indices actually were down in December. Excuse me, most sectors were down in December. So you're saying that there's going to be we're in the middle of a dot-com bubble 2.0. That sounds like a bearish thing because all bubbles pop and then a disaster, of course. But it's not on the short-term basis. It's not necessarily bearish, because if you're halfway through a dot-com bubble, the craziest part is still to end. And that honestly I could see that happening, because I've been saying on this program for close to a year now that maybe longer than a year, that we haven't had all these IPOs of these junky companies. And so all the money has been flowing into high quality companies. We said there's kind of a bubble in quality stocks. And the thing about a quality stock is if you buy it when it's super overvalued, on a long-term basis, your probably total return is probably still pretty good. On a short-term basis, you could get killed, of course. But like, I think that, there's like SPACs that we're going to merge with some AI company. I own the warrants. I sold the warrants. I'm not going to mention the company, but like they haven't done a deal yet. Like, I feel like if this was a true AI bubble, like that company would be public. I feel like there's so many companies crappy companies that are still privately traded. Like venture capital has so much more to dump on the public markets. Do you know what I mean? And they're going to start going on all the podcasts saying about how it's the best company ever. Like, I feel like that hasn't happened yet.
I mean, so far it feels like as far as a bubble is concerned, there is still a lot of discussion about price to earnings ratios and cautionary tales, and so on. Like, I don't know what it was like during the dot-com bubble mania, but from what I have read, it feels like to me, bubble of that kind gets to the point where everybody throws in the towel and just declares a new age,
Yes.
And I don't know if we're really quite there yet. So anyway, I mean, that's an interesting question, right? Is that a bearish prognosis to predict a full repeat of a dot-com bubble? I guess it depends on where in the calendar we are, right? Where on that sort of like, so between 2001 or 2000, I guess the crash, and prior, like, are we still in 1998? Are we in 1995? Or are we in like the last quarter of 1999? So it feels like to me, based on what we just discussed, it sounds like you might agree as well, that we are plausibly still in like 1998 or something, where there can still be things can still get substantially crazier before they everything comes crashing down. But going back to what we were saying before, in that context, the 10-year bonds, right? I mean, you, in the event of a market crash, the 10-year yield will go down a lot.
Yes, but so you said before, I think you were referencing to 1998, the Federal Reserve pause. Maybe I don't know exact timing. Maybe it's because of the blow up of long-term capital management. But anyway, you had this period of the Fed pause. The 10-year yield shot up alongside stocks. So that is a negative correlation, but bonds selling off, so yields going up, stocks going up. So bonds down, stocks up, negative correlation the other way. So I guess stocks are a hedge for bonds, and that's what you see. But so if we have that bubble, I mean, the corollary would play out with yields continuing to go up as stocks go up, and then stocks crashing as yields collapse.
That's right. And if you see the plot of the stock bond correlation, which I can share with you, at least my version, I plot the 2-year weekly return trailing a 2-year correlation. You do indeed see that sort of decline towards the negative, right? And it spikes just during the Dotcom, right? And then it comes back down, towards the definitively negative territory. I mean, sort of as fate will have it, I'm not ruling out the possibility of seeing something similar where we see the reverse, right? Where the stock bond correlation plunges towards negative before it, jumps back towards positive again. So anyway, that's a little bit of a pure speculation about where we are in a macro landscape.
Yeah, macro most of the time, maybe all the time, is speculation. And yeah, needless to say, nothing that you said of Steve Ho, the sharing his own opinion on a podcast, not representative of your employer, Bloomberg. Not representative of your PhD work. Steve, we will leave it there. Thank you for giving us the extra 10 minutes and sharing your macro views. I appreciate it.
Likewise.
Thank you. Just close the door.